Every month, you set aside a little money from your paycheck. $100 here, $200 there. Months later, you look at your account and see $10,000. You feel disciplined and secure. Then you notice something. The number in your account has grown, but your money has actually shrunk. Because while you were saving, inflation was moving faster. So if saving money is the right thing to do, why isn't it making you wealthier? And how can you turn your savings into investments without putting them at risk? In this video, I'll show you which money should stay in cash, which money should work for growth, and how to do it in 5 steps. Because the problem isn't saving, it's giving all of your money the same job. I'm Tommy. On this channel, we talk about practical money systems. Subscribe to learn more and build a stronger financial future. First, let's say something that may sound controversial. Simply saving money does not make most people wealthy. Saving is important, but it is not the only goal. The job of savings is to protect your money. The job of investing is to try to grow it over the long term. An increase in the number shown in your bank account does not mean your purchasing power has increased by the same amount. Your balance may look higher, but if prices have risen faster with inflation, you are not actually wealthier. You have more money in your account, but because that money has lost purchasing power, it buys fewer things. Imagine keeping $10,000 somewhere that earns 1% a year. After 1 year, you would have $10,100. The number has increased, but if inflation is higher, your purchasing power has fallen. You should not put all your eggs in one basket. If the basket falls, all the eggs break. Therefore, if that same money were invested in a diversified basket that grew at an average of 8% a year, it could reach roughly 4.5 times its value in 20 years. This is not a guarantee. Markets do not rise steadily every year. But compound growth turns small differences into large results over time. After a while, not only the money you invest, but also your past gains begin working for you. That is exactly where the real power and change begin. The biggest wealth gap is often not between people who save and people who spend, but between people who put part of their money to work for growth and people who do not. So why do most people fail to make this transition? The reason is not mathematics. It is psychology. Saving makes people feel secure. The money sits in the account, and you know you can access it whenever you want. Investments do not stay still. They move. Sometimes they rise, and sometimes they fall. You may see your account drop 5% or even more in a single day. That volatility scares many people before they even start. You may be thinking, I don't want to lose my savings. That is why the transition should happen gradually, not all at once. Instead of putting all your money in one basket, you need to diversify by giving each part of your money the right job. Step 1. Build a real emergency fund that you can access at any time. Before you start investing, keep 3 to 6 months of essential living expenses in an easily accessible account. This money is not for investing or chasing opportunities. It is for unexpected events such as job loss, medical expenses, or car repairs. The goal here is not high returns. It is to cover an emergency without disrupting your investment plan when something goes wrong in your life. One major reason people panic sell their investments is that they need the money too soon. If you need cash while the market is down, waiting is no longer an option. An emergency fund gives you that option and protects your investments. Step 2. Separate saving from investing in your mind. Think of your money as 2 buckets: safety money and growth money. Safety money stays somewhere accessible and low risk. Its job is not to make you rich, but to cover emergencies without disrupting your investment plan. Growth money is expected to gain value over the long term. You allow this money to fluctuate because you will not need it soon. Money you plan to use within 5 years does not have to be kept in the same place as money you will not touch for 15 years. This mental separation reduces investment anxiety. When the market falls, you know the money you need for everyday life is safe, so you manage your investments according to a plan rather than fear. Step 3. Start small. Many new investors think they need a large amount of money to begin. But the first goal is not a huge profit. It is to build the habit of investing. Starting with a small but consistent amount helps you get used to market movements and stick to your plan. Instead of waiting for the perfect time, you enter the system with an amount you can manage. A common mistake among new investors is trying to find the best fund, the lowest price, and the perfect day. They research for weeks but never start. No one knows exactly how far the market will fall. That is why investing gradually can be more practical than trying to time the exact bottom. Step 4. Focus on simple investments first. A common mistake among beginners is turning to complicated strategies such as day trading, leveraged trades, or short-term speculation in an effort to make money quickly. Broadly diversified, low-cost index funds can offer a more understandable starting point. Instead of choosing a single company, you own shares in many companies. This means your entire outcome does not depend on one company. This does not mean you will never lose money, but instead of tying all your money to a single company, you spread the risk across a wider area and protect your investing mindset as well. As Warren Buffett has also emphasized, a low-cost, long-term system is more practical for most investors. The most powerful investment strategy is often not exciting. It is boring, investing consistently and giving the plan time. Step 5. Automate the system. If you try to invest whatever is left at the end of the month, there is usually very little left. Money becomes available for new spending as long as it sits in your account. So reverse the order. On payday, have the amount you chose transferred automatically to your investment account. That way, investing depends on the system you built, not on your motivation that month. Imagine investing $300 every month. If that money grows at an average annual return of 8% for 25 years, it could reach about $285,000. You would have contributed only $90,000. The remaining roughly $195,000 would come from time and compound growth. The message is simple. More important than how much money you have is how early you start and how long you stay committed to the system. Now let's move on to the hardest part. What will you do when the market falls? Investing is easy when prices are rising. The real test begins when your account falls 10% or 20% and the news starts talking about a crash. At that moment, fear may tell you, sell before it falls further. But your job is not to predict the future. It is to check whether your plan is still valid. Protecting your mindset is important. If your emergency fund is in place, you do not expect to need the invested money for years, and your portfolio is diversified, a market decline does not mean your plan has failed. For a consistent long-term investor, lower prices can mean buying more shares with the same amount of money. For a consistent investor, lower prices can mean buying more shares with the same amount of money. If the market recovers, the shares bought at lower prices can continue contributing more to growth. But not every investment that falls will recover. Thinking, it will bounce back eventually, can cause serious losses. A long-time horizon does not automatically turn a bad investment into a good one. Think about the difference between saving and investing this way. Saving is like storing seeds in a safe jar. You protect them, but nothing grows or develops inside the jar. Investing is like planting some of those seeds in the soil. You do not see the result immediately. Sometimes growth is slow, but with the right conditions and enough time, the result can become much larger than what you started with. The smart approach is not to plant every seed. It is to keep some for safety and put the rest to work growing. Let's summarize. First, build an emergency fund covering 3 to 6 months of expenses. Separate saving from investing. Start with small but consistent amounts. Focus on simple, long-term investments built around a diversified basket. Automate the system and give compound growth time to work. Savings provide stability. Investing, when done correctly, can give you more options in the future. You do not have to choose one or the other. A strong financial system manages security and growth together. Now ask yourself this question and take action. Are you in the saving stage, in the transition stage, or have you already started investing consistently? Write saving, transition, or investing in the comments. The moment your money starts working for you is not the moment you earn more. It is the moment you give it the right job. If you want to keep improving your financial life and building real wealth, hit the like button, subscribe to the channel, and turn on notifications. See you in the next video.